this paper is one we worked on together, Sebastian and I and Elliot Jordan Doak on the Fiscal Council. And basically what we're doing is looking through kind of curious aspects behind interest rates being lower than growth rates and what that means for high debt ratios. And so we kind of make this analogy about debt ratios being at high altitude, kind of like a plane that's flying at high altitude. And it's a useful analogy, not perfect, but it gets a lot of the ideas that are interesting across. And so if we think about three observations in particular, we talk about velocity, instability, and headwinds. Let me just show you what I mean by that. So the first thing, velocity, well, what we mean by that is basically that at high debt ratios, you can see that the pace of reduction in them naturally due to I being less than G or interest rates being lower than growth rates is that they actually fall naturally quite fast because you're magnifying the effect of I being less than G or interest less than growth. And the second observation is that, well, that's a good thing. And we also know that we're able to sustain higher deficits and higher debt ratios in this type of environment. Actually, it's quite an unstable configuration because if things change quickly, then you can find yourself in a reversal of I minus G being negative and finding it positive. And also it means that there's much more uncertainty about the future path due to that magnification of the I minus G effect. And then on the other side, we have this headwinds problem, which is basically that we know there's lots of pressures coming down the line, mainly due to aging costs like pensions and also healthcare. But there are other things like climate change costs as well, which will serve to kind of raise the pressure on deficits and add to debt further, which will push us higher up into that unstable space or keep us there. So the first thing is velocity, and this is a useful way to kind of think through that feature in particular. So if you start at just an illustration of different debt ratios, different heights. So if you start at a debt ratio of 200% of GDP over here, what we call a very high debt ratio as an example, and see what happens for a given interest rate less than growth rate configuration. So here we assume I minus G is equal to minus 3%. And we assume that the primary balance you're running is a deficit of 2% before interest costs. So in that kind of setup, even though you're running a deficit, you find that actually interest rates fall quite fast, from about 200% down to about 170% within 10 years. And you can see that this is common enough for higher debt ratios. But what's kind of curious about I minus G being negative or I less than G, this type of world, is that actually at lower debt ratios, you find it starts to rise. So the benefit is kind of unique to higher debt ratios, and it can lead to quite a fast reduction in the initial phase. But this, and this is true of other configurations of I minus G. If it's weaker, it tends to be more stable. If it's even more negative again, so if interest rates are much lower than growth, then you see actually the decline can be quite fast from higher levels. Now, long run, you don't really see that. What you see is a convergence. So when you're in this kind of I less than G world, what you see is that eventually you will converge in some debt ratio over the very, very long term. And here we look at it over a couple of centuries, but actually it tends to converge around a few decades more so. So if you start at a high debt ratio of about 200%, you see that eventually it will fall down to about 70% in this configuration where we have I minus G is equal to minus 3% and our primary balance is equal to a deficit of 2%. So really in the long run, it doesn't matter where you start out. And this is kind of Olivia's point that ultimately you can run any deficit and you won't have an explosive debt ratio. It'll converge at some point. And that's kind of something that you can be somewhat assured by. But of course, it can be at quite high levels. And so if we look at different I minus G configurations here, if you have interest less than growth by, say, 6 percentage points up here in the top right, and you have a primary deficit of 5%, then it'll stabilize at 86%. And it gets worse then, or you get to a higher stable debt ratio as you run larger primary deficits at weaker I minus G configurations. So if I is still less than G, but not very much so, you'll see that actually you might stabilize at a 515% of GDP debt ratio for a 5% deficit. And this is kind of, it can be seen across the board when you draw it out to the limit. And what's interesting as well about this is if you run a primary balance or a primary surplus, basically in the very long run, you'll just erode any debt ratio you have, and you can even get negative debt ratios, whatever that means. So this all kind of follows from the standard debt accumulation equation, which is the first equation here. And you can see the importance of this debt term in the previous period times this interest less growth rate configuration. So the I minus G setup that you have, and then your primary balance is the next most important term. We'll ignore these stock flow changes for simplicity. And then if you want to reduce debt, you can see that from this equation, you have to have a primary balance that's more than your debt times your I minus G term. Another interesting thing here is if you assume that there is some kind of reason that you can't run primary surpluses beyond a certain level. So if you have political factors or economic factors that mean you can't get to very high levels of surpluses for a long period of time, then you'll find that actually there's a given debt ratio maximum that can be obtained for that. And that's only relevant in the world where interest rates are now more than growth rates. So if interest rates are less than growth rates, there is no limit beyond which things become explosive. So this only matters in that world. And we can see this kind of charted nicely here, where for different growth rates that you would say are plausible for advanced economies, from G is equal to 1% here up to 5%, each of those lines representing a growth rate on average at that rate, you can see that the type of debt ratio point you would have to be at for things to become explosive. So if you were to get a debt ratio above that rate, then it would be explosive. And for different interest rates here. So what's kind of curious about this curve, you see this nonlinearity, is that it's kind of the same regardless of what types of primary deficits you're running. And so what you can see is that very soon as you get to low interest rates, we get this huge upward lift off in the types of debt ratios you can run and sustain. So the limits are pushed out radically in this type of world where interest rates are very, very low. But of course, the flip side of that is if interest rates were to suddenly rise for some reason and you were to get into much higher rates, then the limits come in very quickly and you end up seeing those limits or the ceilings kind of suddenly come down towards where we are. So this is basically where countries now find themselves. So in the kind of pre-COVID world, we saw that the types of primary balances that you would have had to have run to stabilize debt were roughly around the 1% of GDP mark. But as the dynamics changed post-COVID, as interest rates in particular came down, and as the magnifying effect of a higher debt ratio to start with came in, you could see that those primary deficits fell. So that actually now we can run much larger primary deficits and still stabilize the debt ratio. So the second kind of argument then we make is that this is all very good. It means we can sustain higher deficits and debt ratios, and it means we should see a fast pace of decline. But there's instability here. So if you look at the types of factors that are important for this, for how debt accumulates and evolves, you can see that one of those things is the I minus G distribution that you have. And for different countries, there's huge uncertainty around what types of interest growth differentials they've had historically, which kind of leads you to think that maybe there is actually a lot of uncertainty in the future as well about what we might see. And there's less uncertainty for countries like the US and UK, and I've plotted the distribution here of the differential and its density, but actually on the right-hand chart here, you can see it a bit easier. So for countries like Ireland and Greece, where things are typically more uncertain and you have high growth volatility, you can see that the spread around the middle 50% of the distribution, the interquartile range, is much wider than, say, for the likes of the UK and US. So you can have anything from a kind of +2 to +3 percentage point I minus G level to -6 in 50% of the kind of historical cases. And the other side of it then, as well as I minus G being very uncertain, is that surpluses are not often very large. So we can see that if we look back over different periods of time in the last 5 to 6 decades, even further to the 1940s, we can see that the amount of surpluses that are of a very sizable nature have tended to be small. And this curve has kind of flattened in the most recent period. So actually the distribution is much wider. It's not clear that primary surpluses above 3 to 4% are really that common or feasible. And if we take countries, as we do in the paper, and look at what actually happens, we can see that actually what's interesting is for most countries that we look at, there's only about one episode in the last 4 decades where surpluses are above 2.5% of GDP for more than 2 years. So you can see these episodes now and then, but actually they're not really sustained for that long. Now, there are exceptions, of course. You can see that Canada in the 1980s and 90s, after a sustained kind of program of consolidation, managed to achieve it for very long periods of time. So once you do the initial effort and fiscal effort to get there, you do see some sustaining then, but it's not really the rule. It's more the exception. And this chart, I think, is kind of the key one, really, for explaining what can happen when you have uncertainty about these things, I minus G, and when you have uncertainty about the primary deficit, and you're operating at higher debt ratios. You can see that here we're showing how the debt ratio would evolve for illustrative scenarios, starting at 25% GDP debt ratio, 100%, and 200%. And then we see what happens if you have different I minus G configurations. So the central line there assumes that I minus G is equal to minus 2%. And we assume that the primary balance is exactly zero. So you're running a balanced primary budget balance. And you can see that in most configurations, the central scenario basically just leads to a stable debt ratio because you're running zero primary balance and I minus G is minus 2%. Now, in this case, if we have a shock of 2 percentage points, we can see what happens in the worst case scenario. So after this gray line is what happens when a shock comes in. And you can see that at very low debt ratios, the shock is barely really visible in terms of the impact it makes on the debt ratio. So the swing here for a 2 percentage point shock is only about, or the spread between different scenarios is only about 20 percentage points. But if we take it at a higher debt ratio, we can see that the potential range of outcomes is actually equivalent to about 150 percentage points of GDP. So really the uncertainty is just magnified at those higher debt ratio levels for the same shock. And then this has huge implications for the types of adjustments that might be needed. So if we take it that in the EU fiscal rules, a kind of reasonable benchmark for how much a country has to adjust or consolidate or the types of austerity it might have to go through is 0.5 percentage points of GDP in a given year. Then there's caveats around that, but that's kind of the standard. Then we can look at the number of years that hypothetically you would have to do those types of adjustments to get your debt to stabilize. And in the case where you're at a higher debt ratio and you have the same 2 percentage point shock to I minus G, you can see that it could take 9 years. Whereas at lower debt ratios, it basically takes much lower or much shorter periods of time to adjust. So there's potentially very large adjustments there at higher debt ratios if things change. And then there are other risks, as well as the uncertainty around I minus G and the uncertainty around primary balances you run. We also know that there are other factors like recessions or asymmetric shocks. That is that countries like Ireland don't really control their own interest rates, and they can end up in situations where an adverse shock hits them, say something to do with the UK, that is kind of specific to Ireland and doesn't really affect others as much as ourselves. And so the type of monetary policy that's run is less accommodative. We can also see that inflation could be an issue. So in the past, surprises in inflation, that is higher inflation rates, have tended to help reduce debt ratios when they needed to be reduced. But there's risks, of course, that we could be in a low inflation environment for some time to come, and that central banks continue to miss their target. And as well as that, an interesting thing is if you do have to adjust, if you find yourself in a situation where governments are actively pursuing adjustments, then it can be much more difficult to do that in a world where inflation is low, because it's having to come in the form of actual explicit cuts to spending, rather than just growing spending at a slower pace than general price inflation, which is in effect a real cut. Politically, one is more difficult than the other. And then we have other risks like risk premia. I think Olivier mentioned this, so I won't go into it, but basically markets could reassess things quite quickly, and you have stock flow adjustments, which we know in Ireland really is, the types of bank recapitalizations that might suddenly be required, which just magnify very small debt ratios to very large debt ratios pretty quickly if bailouts are required. The last kind of argument then, or the last observation is this issue we have, which is headwinds. So we know that there's lots of pressures coming. And in the long-term stability report, long-term sustainability report that we did recently for the Fiscal Council, we could see that pension spending in Ireland was projected to increase from about 9.5% of GNI star per year to 12.5%, given a kind of aging of the population, particularly as baby boomers move into the older cohorts and the retirement age. And we can see that that if we set that against interest payments, we can see, well, those are very favorable and will likely reduce or stay very low over the whole period, the forecast horizon. We can see this large pressure on deficits from the pension side. And that's also true of health costs, for example. And it's going to have implications for growth. The types of revenues or tax revenues that we'll see from governments will be much lower in future if we have a shrinking work population paying less income tax. And so this chart from the report highlights that very well, which is if we basically switch off the aging of the population and look what would happen, the debt ratio without that demographic change, then we can see actually that the cost would be projected to be way lower. So we would get about half the debt ratio in 2050 that we would otherwise have. And so this is kind of like a plane heading towards, if you follow the analogy, a mountainside where you can see it coming a long way in the future. You know it's going to be very difficult to pull up if you leave it too late. Whereas we can see it now, and really the argument from the Fiscal Council is that you should adjust your trajectory or adjust your course early on, which would ultimately mean less adjustment costs. And it's not just an Irish phenomenon, it's a widespread one. So we can see it in other European countries. Here, we on the left show the increases in government spending on pensions per year from 2020 in green to 2050. And while some countries are actually due to fall slightly, a lot of countries are due to rise. And some of them way more than others. So in this case, Ireland is due to rise from being one of the lowest spenders on pensions in Europe to one of the highest as a percentage of GNI star here, and everyone else as a percentage of GDP for comparative reasons. And on the right-hand side, we accumulate this stock. So if you imagine it as a kind of contribution to debt ratios and also being influenced by I minus G, you find that actually it doesn't really make much of a difference. The accumulation is still very large, particularly for some countries that face these problems more than others. So that's the three observations that we have. We're really trying to tease out what these issues mean in terms of implications for our advice. And we think that there's a lot of questions still to be answered. So thank you.